Good evening. This is group number 8 representing LD Consulting and doing a stock valuation report regarding a potential investment target match group and whether we recommend investing the 250K in their stocks. I have my team here, Will, Fonto, Cole, Deanna, and myself. Let's get started. Based on our report concluding, ultimately we found it is best to invest in this company due to their heavy growth through acquisition, especially with their most recent acquisition of Hyperconnect. However, we agreed on moderate buy based on our calculations, and the online dating market is in its mature state, so a lot of growth is not expected. So, delving into it, Match Group started as an umbrella company for the many dating sites owned by IAC, which is a huge media and internet company in the US. With such a big backing and, of course, cash as well, it showed success and maintained that success through acquisitions and their investment in research and development. To stay competitive in such a fickle market with constant tech and culture changes, Match Group became the global dating service provider due to always doing incremental innovations. Through their innovation strategy, they incubated the growth and acquisition of Tinder, which is now the biggest dating app in the world. Now let's look into the company leadership. We consider this to be the most important because in order to back up their strategy and have the revolving mechanisms of governance and oversight for this innovative strategy, we need to look into their leadership. So we want to emphasize that because of these acquisitions and involvement in incubator programs, Match Group never lacked capable leadership sources and creativity to lead their continuous growth. This prevented organizational inertia, which could have killed their growth, and instead, they've always been innovating themselves or outbuying innovation rather than have someone else become their competition and win over their users. This is not without a loss, as there's been management disputes in their incubation or after acquisition, notably Tinder's marketing founder, Whitney Hurd, who ultimately left their incubation program and built a company that is a direct comparison to Match Group, despite only being one company. However, Match Group has shown multiple actions that they are aiming to have high ESG metrics of being transparent, sustainable, and giving a positive impact on their community relations with multiple campaigns in pushing advocacy and safety of their users. Now, we'll have a look at the online dating market, especially our competitive positioning with our products in the landscape. Dating is a very personal journey, and essentially, these apps are a networking tool to find and connect. And by having a very diverse product line and a large user base, they're able to accommodate and monetize on value created. I'll have you look at the chart. The purple bars are companies owned by Match Group Incorporated. Keep in mind, while Bumble and Tinder have very similar market shares, this chart includes unpaid users as well. Tinder is more monetizable due to the behavior and demands in it for its motivation of subscribing more than Bumble does, due to just the nature and superficiality of the app. As you could also see, the bars add up more than 100% because there's very low switching costs, so users download multiple apps, which enhances the opportunities that Match Group has in monetizing in one of the apps users find value in. With Match Group also having a huge market, people will eventually become users in one of their apps, especially Tinder, because that's where they'll find the most people, forcing them out of smaller alternatives. We've seen that their business model stems from both innovation through integration and internal resources in their incubation programs that ultimately led them to grow these competencies and their resources. In the chart below, you'll see from the mergers and acquisition summary, the purple arrows are where they had acquired new companies, leading to the small investments in the years after 2007, which showed a lot of uncertainty with plans, with a hike from the purchase of Hyperconnect for 1.73 billion. As you could see from their acquisition timeline, all the acquisitions build onto something and shared among their product line. Hyperconnect is highly likely to generate more income with their AI and improved live video capabilities, so we really think there's a lot of growth potential in this.
So now we will be moving on to the quantitative valuation models. And in this section, we will be going over our DCF approach and relative/multiples. To determine the intrinsic value of Match Group, we used a 5-year discounted cash flow (DCF) model, which estimates the present value of future free cash flows to the firm. The three components of our DCF are the cost of equity, the cost of debt, and the capital structure weights, which together form our weighted average cost of capital (WACC), the discounted rate used throughout the model. So to begin, we chose a 3-year adjusted beta of 1.21 because it reflects Match Group's recent volatility relative to the market, while also filtering out temporary fluctuations. The adjustment toward 1.0 accounts for the fact that over time, individual stock risk tends to move back towards the market average, which makes our cost of equity more stable and realistic. We used a risk-free rate of 3.45% based on the Government of Canada long-term bond yield as of April 9th, 2025, which reflects the most up-to-date market-based estimate of a risk-free return. We used a 10% market return based on the long-term average annual return of the S&P 500, which is a widely accepted benchmark for U.S. equity markets. This assumption aligns with historical data and provides a consistent estimate for the market risk premium in our cost of equity calculation. To calculate the cost of equity, we used the capital asset pricing model. We began with subtracting the risk-free rate of 3.45% from our market return assumption of 10%, which gave us a market risk premium of 6.55%. We then multiplied that by our 3-year adjusted beta of 1.21, resulting in a risk premium of 7.93%. Finally, we added back the risk-free rate of 3.45%, giving us a cost of equity of 11.38%. To calculate the company's cost of long-term debt, we used a weighted average approach based on the yield to worst YTW of each outstanding bond. As shown in the table, each bond has a different face value or current amount outstanding, as well as a unique yield to reflect the actual impact of each bond on the overall cost of debt. We multiplied each bond's YTW by its proportion of the total outstanding amount. This gives us the weighted cost of debt for each bond. For example, bond 1 has an amount outstanding of 450 and a YTW of 6.3%. Since the total amount outstanding across all bonds is 3,450, bond 1 represents about 13% of the total. Multiplying that proportion by its yield gives us a weighted cost of 0.82. We repeated this for each bond and then summed up the weighted values to arrive at the total weighted cost of debt, which came out to 6.07%. To forecast the effective rate, we analyzed historical data from 2020 to 2024 using figures for income tax and pre-tax income. As shown in the table, we calculated the effective tax rate for each year by dividing income tax expense by pre-tax income. However, we excluded the year 2021 from the calculation. This is because 2021 showed a negative income tax expense despite a positive pre-tax income, which is a clear outlier that likely reflects the use of a tax credit or loss carryforward, which misrepresents the company's typical tax obligation. By taking a normalized average of the remaining years of 2020, 2022, 2023, and 2024, we arrived at a forecasted effective tax rate of 12.26%. This rate is a more reliable estimate for forward-looking financial modeling. We specifically chose to use the long-term cost of debt rather than a blended overall rate because Match Group's capital structure is entirely composed of long-term debt, including fixed-rate bonds and a term loan, with no short-term debt outstanding. Since our DCF model projects long-term cash flows, it's appropriate that the discount rate reflects the company's true long-term borrowing cost. This ensures consistency between the firm's capital structure and the horizon of our valuation. Using the weighted average YTW on long-term bonds, adjusted for the 12.26% effective tax rate, we arrived at an after-tax cost of debt of 5.33%. To determine the capital structure weights, we used market values as of April 9th, 2025, found under the capital structure section in FactSet. The market value of equity was approximately $7.7 billion, and the market value of total debt was approximately $3.85 billion. This resulted in a capital structure of roughly 67% equity and 33% debt. Summing these amounts gave us as a firm value for capital structure calculation purposes of approximately $11.5 billion. So through all of these calculations, we are now able to calculate the WACC. To do this, we multiplied the cost of equity, which is 11.38%, by the company's equity weight of 67%. Then we multiplied the after-tax cost of debt, which is 5.33%, by the effective tax rate of 12.26%, and then by the debt weight of 33%. And adding those two components together gives us a final weighted average cost of capital of 9.36%. To build a reliable and well supported DCF model, we pulled data from a wide range of sources within FactSet. This included the income statement, balance sheet, and cash flow statement, along with their respective forward looking estimates. We also used both historical and estimated financial ratios to guide our assumptions and ensure consistency across our projections. The left side of the table shows historical data from 2020 to 2024, while the right side reflects consensus estimates from 2025 through to 2029. These inputs include key operating metrics such as sales, EBIT, EBITDA, interest expense, capital expenditures, working capital, and free cash flow to the firm. Using multiple data sets allowed us to cross-reference line items, ensure consistency between forecast periods, and support multiple calculation methods for FCFF, all of which strengthened the credibility of our valuation. By combining both actual financials and professional analysts' market-based estimates from FactSet, we ensure that our DCF model reflects both the company's historical performance and forward-looking expectations. This slide shows how we calculated free cash flow to the firm, or FCFF, which is the core driver of our DCF model. We used data sourced from FactSet and calculated FCFF for each year from 2020 through to 2029 using multiple methods to cross-check our results. The 5 methods shown here begin with different starting points of net income, EBIT, EBITDA, operating cash flow, and CFO from the cash flow statement, and then apply adjustments for non-cash charges, capital expenditures, and changes in working capital. You can see the specific formulas used at the bottom right of the photo. For example, starting with EBIT, we applied the formula FCFF equals EBIT times bracket 1 minus tax rate bracket plus D&A minus CapEx minus change in NWC. This ensures we're removing the effects of financing decisions and focusing purely on the operating performance of the business. To estimate a defensible forecasted growth rate for our DCF model, we analyzed key per share metrics from 2020 through to 2029. This included sales per share, book value per share, EBITDA per share, free cash flow per share, and earnings per share, using both historical and projected data sourced from FactSet. We calculated the annual growth rates for each metric over time and then took an average across categories. On the far right, you can see the summary table comparing the historical growth rate average of 7.78% to the forecasted average of 18.38%. These growth trends helped inform our cash flow forecasts, and we specifically used them to build our stage 2 terminal growth rate assumption, which we will cover shortly. Using per share data gives us a more detailed view of underlying performance since it accounts for changes in share count due to dilution over time. This slide shows the output of our two-stage discounted cash flow model, which we use to estimate the intrinsic value of Match Group's equity. We chose a two-stage DCF model because Match Group is a mature, publicly traded company with relatively predictable cash flows in the near term, but slower, more stable growth expected over the long term. The first stage allows us to model detailed year-by-year cash flows based on an analyst estimates and company-specific assumptions through 2026. The second stage, or terminal value, reflects the idea that after this forecast period, the company's growth will gradually level off to a long-term rate more in line with broader economic conditions. This approach is well suited for companies like Match Group that are past their high-growth startup phase, but still generating strong recurring free cash flows. A two-stage model offers the right balance. It provides enough detail in the short term while simplifying the far future, which is hard to forecast with precision. In stage 1, we projected free cash flow to the firm from 2025 to 2026 using our forecasted inputs and discounted them at our calculated WACC of 9.36%. This gave us a present value of around 1.5 billion. For stage 2, we used the Gordon growth model to calculate the terminal value at the end of 2026. We base this on a 2.5% terminal growth rate, which reflects a reasonable long-term rate consistent with industry and economic expectations. After discounting the terminal value back to present, we arrived at a stage 2 value of $10.7 billion. Dollars. Adding both stages together gives us an enterprise value of $12.2 billion. Dollars. From this, we subtracted net debt of $2.96 billion dollars to arrive at a value of common equity of $9.25 billion. Dollars. Finally, by dividing that equity value by the number of shares outstanding, we estimated a basic share price of $36.95 and a diluted share price of $35. As of April 9th, 2025, Match Group was trading at around $29, while FactSet's consensus target price was $36.45. Our DCF based valuation of $35 per share diluted showcases the strength of our model being both realistic and aligned with market expectations from professional analysts. It also suggests the stock is currently undervalued by roughly 21%, reinforcing the idea that there may be meaningful upside based on fundamental cash flow performance.
All right, so moving on to the relative multiple valuation. Match Group and Bumble Inc. are two of the leading companies in the online dating industry. They both have very similar business modules as well as a global reach. And Bumble is a company that we selected to evaluate or compare Match against as a peer company. So to begin with, Match Group owns and operates a portfolio of very well-established brands such as Tinder, Hinge, OkCupid, Match.com, all those companies that we mentioned earlier. This also makes it a very dominant player in the sector, and it generates its revenue primarily through paid subscriptions, premium features, and running ads across its platforms. On the other hand, Bumble is a younger and smaller company in scale, and it's known for its app, Bumble, which is also a dating app. And that app typically emphasizes female first connection. So it's a little bit different from what Match has to offer, but similar things. It also owns Badoo, which is another dating platform that's very popular in international markets. And since Bumble is still in its growth phase, it is reinvesting very heavily into its expansion and product innovation. So in order to evaluate these two companies fairly, I selected the price to free cash flow, the enterprise value to EBITDA, as well as the price to sales multiples to perform this valuation. So the price to free cash flow multiple was chosen because both companies generate a meaningful cash flow, and this multiple offers insights into how efficiently they convert their revenues into actual cash, which is particularly important for tech companies with high non-cash expenses. The price to sales multiple is appropriate for growth stage companies like Bumble that may not yet show strong earnings, allowing us to value them based on top of the line performance. And lastly, the EV to EBITDA multiple is a widely used metric for comparing operating profitability across firms regardless of the capital structure, and it's especially useful for Match and Bumble, which have differing debt levels, but they both report their EBITDA. So as we can see from the calculations from the last slide, feel free to go back or reference the Excel sheets that will be attached to this presentation. But as we can see from the last slide, the Match Group commands a significantly higher valuation. So that's across all three methods. So that's the cash flow, the sales, and the earnings. So if Jessica, the investor, is seeking a stronger return in the short to mid term, then Match Group would be the better valued company due to its higher revenues, cash flow, margins, and more substantial operational base and investor confidence. However, on the other hand, Bumble is still scaling, and so it's valued as a growth company with lower margins. Its multiples are lower across all categories, indicating that investors may be cautious about Bumble's short to mid-term positioning and prospect, as well as the risk profile. However, because Bumble is lower valued, it could be interesting for a long-term growth bet, but it is riskier on the lower monetization, smaller user base, brand diversification, and less operational efficiency. So as I mentioned earlier, you can also go back to the previous slides, kind of get a better understanding of the calculation that we performed. We did an average of all three multiples that we chose to come to the conclusion of the multiple valuation for both Match as well as Bumble and what that meant for each company.
So on to the further analysis evaluation section. I'll talk about the non-quantitative factors that could affect the outcome of our valuation of match group. So while our group's DCF and multiples provide structured valuation outputs, they also kind of rely heavily on assumptions and like such as growth rates, margins, and some discount rates that can be influenced by real-world qualitative uncertainties. In my section, I look at the key areas that could materially affect match group's long-term valuation, such as regulatory and legal risk, competitive landscape, platform and user behavior risk, macroeconomic context, and then I'll do a brief ratio analysis at the end. So on the regulatory and legal risk, Match Group actually operates in over 40 different countries worldwide, and it must comply with the growing web of data privacy and consumer protection laws that are being implemented. The two biggest that it's had to face are the GDPR in Europe and the CCPA in California. The General Data Protection Regulation, GDPR, it's a European Union law that governs how organizations both within and outside the EU handle the personal data of EU residents. And the other one being the California Consumer Privacy Act, CCPA, is a California state law that was introduced in 2018 that provides California residents with more control over their personal information. This includes the right to know, delete, and opt out of the sale of their personal data. The laws actually limit how companies collect, store, and use personal data. And for business model like matches, where the monetization of user data and engagement metrics is crucial, there is a major risk to both revenue and margin assumptions. Match has also faced legal scrutiny in the past for billing and auto renewal practices. They've had some lawsuits and investigations in the U.S. and parts of Europe because of this. It raises their ongoing compliance costs, which creates potential for future fines, and also introduces volatility into their international expansion strategy. From a valuation perspective, this could mean like lower operating margins, higher risk premium in the discount rate, or even a more conservative revenue growth forecast. The competitive pressures, major external risk. So Match actually owns a lot of popular platforms like Tinder, Hinge, and OkCupid for a couple of them, but the dating app space is becoming increasingly saturated and also harder to dominate nowadays. Um, the closest direct competitor actually is Bumble, but there are also some fast-moving entrants like Grindr and Plenty of Fish, and even some indirect competition from from companies like Meta with their Facebook dating and also just Instagram in general because people can just DM each other willy-nilly nowadays. I think that the core issue here is that dating apps have low switching costs, and so users can download a new app in seconds, and then the loyalty is typically low. And so it makes user acquisition and retention costs high, which puts a lot of pressure on EBITDA margins as people can just switch whenever they want and they want the newest thing, the best thing. So whenever something new is introduced, they'll happily switch over if it's got no cost. Also, many competitors are innovating more aggressively nowadays too. They're introducing AI matchmaking tools, some video first dating types, and even some gamified features that are appealing more to the Gen Z population, which is most of the dating population. So if Match doesn't keep up with this, then the churn could rise, ARPU could drop, and also their market share would decline, which would force us to adjust the growth forecast downward in the valuation model. So on to platform risk and user trends. It's more internal, but it's also equally as critical. Match generates around 50% of its revenue just from owning Tinder. The kind of reliance on a single platform that they have with this creates a lot of concentration risk. And so if Tinder underperforms, it'll actually drag down the entire company's financial performance. So they've got a lot of eggs in that basket. On top of it, there are also some signs of user fatigue with swiping-based apps, and especially among Gen Z. This generation is more and more interested in authenticity nowadays. They want to have shared interests with people, and video or community-based dating as well. Some other concerns that they face are catfishing, ghosting, and some safety issues, which pushes users to explore alternative social or matchmaking platforms that are out there. If Think Match fails to respond to these behavioral shifts, we could see a fall in user engagement very easily. and a lower conversion to basic paid subscriptions, as there's so many free ones out there. Both of these things would reduce the base case cash flow estimates. With the strategic implications for the valuation, I want to talk about that and the macroeconomic implications for Match Group's valuation. First, from the macro perspective, Match operates in a consumer discretionary space, so it means it's sensitive to broader economic trends. And with everything going on right now in North America and just the world in general, with the rising politicians' powers and tariffs and whatnot, I think that with it being a dating site, it's not going to have that much priority in people's lives. So we could see like an economic slowdown and a period of high inflation, which means users are more likely to cut back on spending for non-essential services, and dating app subscriptions fall right into that category, in my opinion. Also, rising interest rates raise Match's cost of capital, which would directly impact our weighted average cost of capital in input in the DCF model, which reduces the present value. At the same time as this, global macro pressures such as currency fluctuations, regional instability, or even unemployment rates can affect Match's ability to grow internationally, especially in emerging markets. Onto the strategic side, when you combine all of these qualitative risks that I talked about with the regulatory, competitive, behavioral, and macroeconomic, there's a strong case for applying a valuation discount or a higher risk premium in the model. It's important to remember that valuation isn't just math, but it's also about estimating the future cash flows under the uncertainty, and that the real-world factors shape that uncertainty in a very meaningful way. So here you can see the ratio analysis. And to support the qualitative factors that I was discussing, I wanted to pull these financial ratios from FactSet so I could get a clear picture of Match Group's financial health and capital structure. So first, you can see that the leverage has been trending down. So net debt to EBITDA has decreased to 2.9 in 2023, which is a positive sign. It means that the company is basically managing its debt load better than it was a few years ago, so reducing the financial risk that they have. After that, the interest coverage ratio, so EBIT divided by interest expense, it's sitting at 5.73, which tells us the Match is comfortably covering its debt payments. So that reduces the risk of financial distress and supports a lower cost of debt and valuation models. So I suppose them relying on Tinder a lot has actually been paying off, which is kind of funny in my opinion. Their gross margins also remain very strong. They're consistently above 65%, and then free cash flows margins are also very solid, around 24%. It means they're generating consistent cash that can support reinvestment, debt reduction, or shareholder returns, which is attractive for a company that you're looking to invest in. It's also worth noting that the EV/EBITDA multiple has compressed significantly, dropping from 44 times in 2021 to just around 12.6 times now. That kind of signals some market skepticism about the future growth or confidence in Match, and it's kind of something to consider in the relative valuation. Overall, the ratios kind of help validate the earlier analysis, and Match is actually in a stable financial position. But
for Match.com, we recommend a moderate buy to enhance and diversify your portfolio. Both our DCF and relative valuation show that Match is a highly undervalued company. As discussed, the DCF valuation implies a price of $36.50, where the current stock price sits at about $29. We recommend allocating about 10 to 15% of your portfolio to this investment, given its relative undervaluation compared to peers like Bumble. Although the company does have its risks, firstly, there's a heavy revenue dependence on Tinder, which is a significant concern. Secondly, the industry faces low switching costs, meaning users can easily change platforms alongside changing user behaviors and potential app fatigue. Finally, there's regulatory exposure due to privacy concerns. On the other hand, the company is a market leader with robust brand power and investments in AI innovations with its acquisition of Hyperconnect. They also benefit from a recurring revenue model through subscriptions coupled with strong revenue growth. With these factors in mind, we believe this investment holds great potential. This concludes our presentation on Match Group. Thank you for your time and attention. We appreciate the opportunity to share our analysis and hope you found the insights valuable.